Ladies and gentlemen, good day and welcome to the Bandhan Bank Q1 FY24 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vikas Mundra. Thank you, and over to you, sir.
Thank you, Robin. Good evening, everyone, and a warm welcome to all the participants. It's our pleasure to welcome you all to discuss Bandhan Bank's business and financial performance for the quarter ending June 2023. We will take this opportunity to update you on the recent developments in the industry as well as on Bandhan Bank during the quarter. To discuss all this in detail, we have with us our founder, managing director, and CEO, Mr. Ghosh, Chief Operating Officer, Mr. Ratan Kumar K, Chief Financial Officer, Mr. Sunil Samdani, Head Retail Banking, Mr. Shantanu Sen Gupta, and myself, Vikas Mundra, Head of Investor Relations, along with other senior management team of the bank. We will be happy to provide you with any clarity if required from the current quarter numbers and the way forward. Now, I would like to request our founder, MD and CEO, Mr. Chandrasekhar Ghosh, to brief you all about our bank's operation and financial performance, along with development for the quarter ending June 2023. Over to you, sir.
Thank you, Vikas. Namaskar. Warm welcome to all of you. After the strong financial year 23, I am pleased to state that the April to June 23 quarter has also been a stable quarter for the bank. I will take you through some of the key figures. The macro backdrop continues to strengthen. India looks set to remain world's fastest growing large economy. India's GDP is expected to grow at about a strong 6.5% during financial year 23-24, with the prospects of strong private consumption and services sector growth. Despite a late onset of monsoon, weather disruption in few states and delayed showing during quarter 1-24, the gradual improvement in rural demand may continue in the coming months if the forecast of a near normal monsoon by IMD true. Despite the policy under uncertainties in advanced economies, India's inflation of 4.6% year-on-year during quarter 1 financial year 24 suggests a limited risk of further hike in interest rates in the near term. Prospects of decent GDP growth and stable interest rate environment should help the momentum in Indian BFSI sector in the coming quarters. Having said that, one must note that the first quarter of the financial year is often seasonally a somewhat softer patch for several entities in the financial services industry. Thus, quarter-on-quarter figures should be analyzed and interpreted carefully. During quarter 1 financial year 24, Bandhan Bank's overall advance have shown a 6.7% growth year-on-year and a marginal decline in quarter-on-quarter. The quarter-on-quarter decline in loan book is primarily because of two reasons. We have seen a quarterly decline in the microfinance book around 10% quarter-on-quarter, primarily due to seasonal factors and because of weather disturbance in a few states. Historically, also, if you see, for the last 2 financial years, we have always shown a quarter-on-quarter drop in a similar range in quarter 1 in our microfinance book. Second point, we also seen that, as indicated earlier, we had a short-term loan against the fixed deposit, of which a single large account of 2,151 crore has been repaid in quarter 1 24, which helped us to degrow of the book of advances. However, growth in case of retail asset and commercial banking continued to be impressive. The retail loan book, other than the housing finance book consisting of personal loan, gold loan, two-wheeler loan, and auto loan, has grown by nearly 87% year-on-year. The commercial banking vertical consisting of financial institution group and SME registered a growth of 78% year-on-year and nearly 7% quarter-on-quarter. The housing finance book, the housing finance book, which faced issues last quarter, has come back to normal and has registered a growth of about 9.5% year-on-year. The share of secured assets as a part of our total loan book continues to increase. It crossed 44% in quarter 1 financial year 24, as against 36% in financial year 22. We expect that approximately half of our book should be secured book by financial year 26. On the liability side, deposits at 1,08,000 crores as at end June 2023 recorded a growth of 16.6% year-on-year, stronger than the industry growth rate of around 12%. Due to our focus on granular retail deposit, our retail term deposit book has grown by around 17% year-on-year. The retail to total deposits ratio continues to hold above 71%. Customers continue to respond their trust in the bank. Let me put forward a few data points in substantial the same. Our total number of liabilities customer increased by 11.5% year-on-year and 3.4% quarter-on-quarter. Volume of total customer transaction increased by more than 50% year-on-year, 9% quarter-on-quarter. Total value of transaction has also increased by 15% year-on-year, 5% quarter-on-quarter. Our overall digital transactions have recorded an increase of 49% year-on-year, with average digital transaction per account going up by 33%. All these parameters shows that the bank are performing, especially in the retail segment, is very good, and future it will be like to continue very good growth of this deposit. CASA deposit came in slightly lower on account of seasonal impact compared to the previous quarter, but still stands at a healthy 36% at rupees 39,077 crores. This drop in the quarter has been seen across the industry, but we have the confidence on our customer, and my team will be again come back on that, which is projected 40% of our CASA growth, CASA percentage. I would like to specially highlight that microfinance customers contributed only less than 4% of our total deposits. We have seen good improvement in the overall collection efficiency for the bank. Overall collection efficiency, excluding NPA, stood at 98% for the quarter end June 23, up from 96% from the quarter ending June 22. The bank has registered a net profit of rupees 721 crores during the quarter 1 financial year 24, against a net profit of rupees 887 crores in quarter 1 financial year 23. Our net interest income in quarter 1 financial year 24 came in at rupees 2,491 crores, broadly similar to rupees 2,514 crores during Q1 financial year 23. However, sequentially, it is also stable at rupees 2,472 crores in Q4 financial year 23. Our net interest margin stood at 7.3% in Q1 24, same as that during Q4 23. It is a very strong parameter for the bank on that. The NIM has continued from the last quarter, also the same in this quarter. Total credit cost for Q1 24 was 2.4% compared with the 2.9% Q4 23. Our gross NPA in Q1 24 stood at 6.76% compared to the first quarter of the last year, 7.25%. Our net NPA has come 2.19%, and what was in a 1 year ago 1.92%. The bank delivered an ROA of 1.9% and ROE 14.4% in Q1 24. This quarter, we have added about 130 branches, over 70% of which are in northern, southern, and western zones. We have added about 7 lakhs new customers in this quarter. What is the future? We have made considerable investments in people, technology, and infrastructure in recent years. We expect that from the current financial year, the bank will start yielding positive results of these investments. Of late, we have initiated several steps to boost cross-sale and branch-led sales to grow the retail assets and liabilities portfolio, and also to increase productivity per employee supported by our digital and analytical initiatives. Financial year 24, we expected to grow our advances by nearly 20% plus and a little higher rate for deposits growth through 24, with our focus remaining strong on the retail segment and the diversification with NIM, which I projected 7%. We expect credit cost to remain around the 2% with a variance of 20 basis points. Puja is coming near future, which is this quarter, which is second quarter. We think that Puja has been helped after to credit growth again will be start for this year, and whatever we have been declined will be like to recovered by the March, and with our growth of the bank of advance 22% plus. I wish you and your family all the very best. Thank you.
Thank you, sir. Now I would like to request Mr. Sunil Samdani to give you some more details on the financial parameters during the quarter. Over to you, sir.
Good evening, ladies and gentlemen. I would want to take this opportunity to take you through some of the key highlights of the quarter in terms of financial numbers. Starting with collection efficiency. The collection efficiency excluding NPA customers continues to be healthy at 98%. The full paying customer continues to be reasonably high at 96%. Now moving to the DPD movement, you would witness that quarter on quarter, the movement in DPD has been stable with two major changes. One is 61 to 90 bucket and the NPA bucket. As far as the movement in 61 to 90 bucket, I would want to mention here that the ECLGS loans, which we have classified as NPA during the quarter, pursuant to change in IRAC norms by the regulator, these were earlier shown as stressed assets and were forming part of 61 to 90 day bucket. And the NPA, as we discussed the slippages number, will make it amply clear as to how to view this NPA number. Now first let me take you through this adjustment of ECLGS. As Bandhan, we have taken this guarantee under NCGTC two schemes. One is the ECLGS fund and the second is the CGFMU guarantee. As far as CGFMU guarantee goes, since it was in the nature of insurance, where we pay the insurance premium to get that guarantee, whenever the customer crossed 90 DPD, we used to mark it as NPA and accordingly take provisions against them. As far as the ECLGS loan goes, these are 100% guaranteed by the NCGTC fund, and since there is no insurance premium, there is no premium paid and it is not in the nature of insurance, as per the IRAC norms then, since they are government guaranteed, we had not classified them as NPA. However, looking at the nature and the repayment track record, we felt that these are stressed customers. Accordingly, we used to classify them in SMA2 bucket, which is 61 to 90. Now what changed? Starting 1st April, the new IRAC norm circular came in, which made it amply clear that all loans granted under the umbrella of NCGTC and the CGTMSE should be treated as NPA. Further, they said that banks are permitted not to make provisions against these exposures. So where do we stand against these new norms? So as mentioned earlier, the ECLGS pool, which was part of our stress pool under SMA2, we mark it down to NPA. As far as CGFMU pool goes, that pool always was marked as NPA and continues to remain NPA. While the circular clearly says that the banks are permitted not to make any provisions, as a prudent and conservative measure, we have a coverage of 86% in terms of provision over these loans of NCGTC under ECLGS and CGFMU. So that's the material change for the quarter. How does it impact our stress pool? It has absolutely no impact on our stress pool because the ECLGS was earlier also classified as stress asset as part of SMA2 and it continues to remain stress asset now under NPA. So what's our stress pool looking like? March 23, this amount was 55 billion with a stress pool coverage of 55 billion with a provision of 38 billion and the CGFMU guarantee of 17 billion. In June 23, this amount goes up to 62 billion and the coverage increases to 103 billion with 21 billion of guarantee cover and 43 billion of provisioning in place. I would also want to take you through the slippages during the quarter. During the quarter, we had a slippages of 13.6 billion. I'm talking here the gross slippages. And if I have to break this number of 13.6 billion, about 9.2 billion comes from the EEB, 2.2 billion comes from housing, and the rest from the other businesses. How do we read these slippages and what's the status on the recovery or upgrades? As you all are aware, during the last 6 months, starting December 28, we had sold a substantial pool to ARC and have also got a guarantee repayment from the NCGTC of 916 crores. So as a result of that, any recoveries in those accounts, we have to first pay to the NCGTC if it's an NCGTC customer recovery, or if it's an ARC customer recovery, we pay it to ARC as per the terms of agreement till their claims are satisfied. Now let me first clarify on the slippages number. The 2.2 billion or the 220 crores of slippages that we saw in housing is more of the initial issues that we faced during the new system implementation. These customers slipped and we had an immediate upgrade out of which of 1.6 billion or 160 crores. So technically, the other way to look at these slippages of 13.6 billion would be to reduce these 2 billion from there. Secondly, since we have sold this portfolio, a large chunk of this, to ARC, and we've received the claim from CGFMU in the month of December, the recoveries that we do from our customers are allocated towards repayments to these two entities. So while the recoveries and upgrade numbers in our balance sheet looks at 2.8 billion or 280 crores, the real recovery from the customer stands at 550 crores. The rest either goes to ARC or to CGFMU. So this being the first quarter after those material transactions, which happened at the end of Q3, which is 28th of December, and in March, the real impact of recovery is felt in these quarters, wherein the bulk of the recoveries go to the outside agencies. Now, where do we stand on the ARC pool that we have sold? How much more we need to pay to them? As you all know, we did this transaction in two tranches, one in December end and the other one in the March end. In the December end, the contribution from the ARC and the investor was 414 crores. Of that, the total collections we have made is 424 crores. So which effectively means that by the end of this quarter, I mean the second quarter, we would completely repay our obligations towards the tranche we did in December 22, including the IRR. This effectively means any further recovery towards this portfolio will start flowing into the bank's P&L. And that's where we will see these numbers improving in terms of recoveries and upgrades. As far as the other pool goes, which is the pool which we had done it in the month of March, the total receipt of those two pools between the write-off and the NPA portfolio was about 362 crores, of which 150 crores, I beg your pardon, 250 crores is something that we have already collected. So clearly, we see a scenario starting H2, this recovery of close to 300 crores per quarter should start flowing into the bank's P&L. Thank you very much for your patient hearing. I'm sure you will have few questions. Happy to take them. Thank you.
So, David, please start the Q&A part.
Yes, thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Marup Adajania from Nuvama. Please go ahead.
Yeah, hi, good evening. So, over what time frame do these ECLGS NPLs leave the book? And
No, Marup, can you please repeat your question, please?
my question was that, these are covered by guarantee. So, over what time frame do these ECLGS NPLs move out of the book, as in get resolved? You can recover the guarantee and, you can get the guarantee and resolve them, right? So,
Sure. So here now there is a difference between the processes of claim that we do between CGFMU and the ECLGS. Currently, under ECLGS, you have to upload a single case-by-case details into their portal. And that's where they have a constraint in terms of, the processing. And that's why this process of claiming is slightly slow because of the capacity constraints. On the other hand, the CGFMU is a bulk upload, so that happens faster. What we are given to understand, that similar facility of uploading bulk or through a confirmation through CIC is underway, and that should help speed up the processes of recovery, the ECLGS guarantee loan. And hopefully, in another 3 months or max 3 to 6 months, we should be able to recover the entire ECLGS claim.
got it. That's helpful. And my next question is, just on the SME pool, right? So on an average, how much do you see would accrete to the SME pool every quarter from now on?
No,
So
before I take your next question, just to add to your first question, that of this ECLGS book of 580 odd crores, this quarter we have recovered from our customer close to 85 crores. So even organically, that recovery from the customer is happening faster. And as the claim comes, we expect this to be clear. Sorry, I interrupted you. Can you please repeat your next question?
Sure. So on a normalized basis now, what is the ballpark range of accretion to 1 to 30 DPD? Any range you could suggest?
So, normally with 98% collection efficiency, that accretion should not be more than 2%. Right? We've always seen in our business, there is an element of seasonality where the Q1 disbursements are lower, and because of the flood season, the monsoon season, the movement into the DPD bucket is slightly higher in the first 2 quarters vis-a-vis the last 2 quarters. Particularly Q1, where the slippages are the highest, and then keeps on reducing as the quarters go by. So we expect the slippages number to reduce starting second quarter onwards.
Okay, makes sense. And my last question is, so what kind of recovery through the income statement could we expect from ARC sales, say, in FY24?
So as I said, for this quarter, between repayment of ARC and CGFMU, the total amount is 270 odd crores, between 2.3 billion in the ARC pool and 42 million in the CGFMU pool. 420 million, I beg your pardon. So both put together, it's about 270 odd crores in Q1. And as I said, Q1 is historically the weakest quarter. So that's the minimum we should look at.
Okay. Thanks a lot. Thank you.
Thank you. We have the next question from the line of Nitin Agarwal from Motilal Oswal. Please go ahead.
Yeah, hi. Thanks for the opportunity. So firstly, if you can share a data point on the interest reversals that we had during the quarter And how do you see therefore the margin? Because despite the reversals, therefore the margins have still held up well. So how do you see that going ahead?
So here again, Nitin, I'll break this portfolio into two parts. The ECLGS pool which slipped and the other than ECLGS pool. ECLGS, we had reversed the interest long back as and when it became 90 plus, though it was never classified as NPA as per the extent RBI guidelines, and we never accrued interest on that. So the reversal on that pool was not there. For the other businesses, that reversal number, I'll just get that number and I'll tell you.
Right. And secondly, while on ECLGS you mentioned that the money is expected in 3 months, maximum 6 months, but on CGFMU, like how that organization taking up to the big claims that you are facing with them, do you expect the money to come on time because there is one more tranche that is expected in FY25? So can there be delays here?
No, so we don't see a delay there other than the procedural delay. We expect that money to come in by July end or at best August, first half, and that's the expectation we are working on.
Right. Okay, sure. Thanks so much. If you can later on just check with the reversal number.
Thank you.
Thank you. The next question is from the line of Jay Mundra from ICICI Securities. Please go ahead.
Yeah, hi, good evening, sir. My first question is on provision. So total provisions, I think last quarter was some, what is the quantum of total provision? We have given 4,300 crores provision for EEB, but what would be the total provision, including all, contingent, etc.?
The total provision as on June end stands at 57.5 billion.
It is largely unchanged, right, from last quarter, around 50.8 billion something.
Yeah, so it's gone up, by 7 billion odd.
Sorry, you said 57 billion.
57.25.
Okay, sure. So, sir, that suggests that, what I'm trying to calculate is the PCR on the non-MFI businesses also, while of course they are more secured, they have housing and commercial, but still it looks like that the PCR on the non-MFI business is relatively lower. Maybe that is the nature is secured, so maybe that is still okay, but is that the math roughly right?
No, so I'll give you the broad breakup. On the SME loans, we are covered around 58% in terms of PCR. The retail is about 45% and the housing is about 40%.
Okay. Sure. Good. Second question, Sunil, is on SMA 012 number, right? So, despite I can adjust the 580 crores from which have gone out of SMA 2 pool, but if I look at SMA 1, 2 adjusted for this 580 crores loan, that is fairly unchanged, right? Even the SMA 0 has actually gone up only. So while the collection efficiency has marginally lower from 98.5 to 98, the SMA pool is still unchanged. Right, so any thoughts there?
No, so in a scenario where, the collection efficiency has dropped by 50 basis points and the SMA numbers have remained flat, I think one should look at it positively, because a steady state credit cost number we are paying 2%, so which effectively means the flow rate from current till NPA at some point of time has to be in that range of 1 to 2%.
Okay. Right. Okay, and safe to say that all this, the entire ECLGS linked loans have already been downgraded to NPA and nothing of such kind can reoccur, right? Because it would have done at the entire portfolio level across people who are, let's say, even okay. So mostly all these were the only technically 90 DPD only.
90 DPD. Yeah. So if you recollect, my total ECLGS disbursements were close to 4,000 crores when we did it in 2021. The outstanding pool today is less than 600 crores, which effectively means that I have recovered close to 90% of that customers.
Right. Understood, sir. Yeah. Thank you so much and best wishes, sir.
Thank you.
Thank you. Ladies and gentlemen, if you wish to ask a question, you may please press star and 1. The next question is from the line of Saurabh Kumar from JP Morgan. Please go ahead.
Sir, just two questions. One is you guided for this 20% loan growth. So that means nearly 30% growth from your, first quarter numbers. So how do you think about that, especially in the context of, you said that the diversification needs to be higher. So fair to say that one should expect a very sharp pickup in growth. At least the housing finance business going ahead. I'll come back to that.
Will add on the number side. Let me tell you, we've always seen a growth in first quarter. So last year when we ended at 10-11% growth, it was on the back of almost 11% either written off or sale to ARC. Adjusting for that, it was a close to 20% growth with the same situation of close to 8% drop in first quarter. So I think that's on the number side, and want to add on the growth.
No, what you say that if you look on that the last year, first quarter, there is also microcredit has been 5,000 crores have been down, declined. And this year also 5,000 crores declined. And microfinance loan, we have the disbursed in the last year 8,200 crores. This year also first quarter we are disbursing 8,000 crores. So in that sense, if we see that the similarity of the last year first quarter and this year first quarter is the same point. And the next point on that, this growth actually as coming from the 1 month before from Puja. And it will be like to September, it will be in this year will come. Sometimes Puja will be like to September, then it will be starting August. So this is the way we have been seeing in a trend of the last 20 years. So I have the confidence on that this year it will be again, this quarter it will be come to again. Again, another point I told that. So whatever we are seeing that the decline in April and May, June we have been seeing that very minor 200 crores is a difference between outstanding and the decline on that. And whatever we see that in July, it is going on that such a way, I feel that the July will be also not going down further. For that reason, I have the confidence on that the 20% plus growth, it will be happened in the bank, not any problem.
Sir, if I can just ask of this 20%, how much would you expect the microfinance business to grow by?
Microfinance growth, we have been given the 17% on that.
Okay. And the second question, sir, is effectively if your first quarter collection efficiency is 98. So I just want to know if this 2% which slips into this SMA, 0, what should be the expected credit loss now on this? Because this is just, on-time collection, right? So what should be the credit cost? Should it be around 1.6, 1.8%?
No, I have been looking in a different way on that. The 1 quarter, which is in my portfolio has come as a decline. That is also little bit impacted to the collection efficiency. This is also as a seasonality. That not means it will be continuing the full year and quarter on quarter basis same line. No. If you go to that, it will be improved again from the second quarter. And it will become if you say that compared to the last year first quarter, it was a 96% collection efficiency. It has come to the 98% within 1 year on that, 2% increase. So we expected on that this for the financial year when it will be like the next financial year, it will become to better than that percentage. So in that sense, on the basis of quarter first, we cannot be count only the credit cost. Credit cost count the total year performance.
No, I got that, but effectively, if your collection efficiency is 98, so 2% is slipping forward. I just want to know typically what is the loss rate on this or the NPA rate on this 2%?
I hope that it will be that we are thinking on that the 2% will become on the credit cost,
which is overall, not on this pool. So broadly, between the SMA buckets, all right, we've seen that 30 to 40% remains in the SMA once it crosses the 60-day DPD, and the rest flows, between 30 and 60-day DPD. So that is how one should look at it.
Sunil, my limited point is basically you are presenting to us that the SMA pool and the NPA pool is fully covered. So I just want to know from an incremental basis, if your collection efficiency remains at 98, what should be the core microfinance credit cost? I mean, from an incremental slippage basis, that's the limited point I'm trying to get at.
So that then on the incremental side, it should be around 2.5% on the EB portfolio. Because, there are two things. You look at 98% collection efficiency. The other number, which is also important to look at, is the full-paying customer. The full-paying customers today stands at 96%, which means there are 4% customers whose DPD is constantly going up. Right? They are paying half of their installments, which means that benefit is coming into the collection efficiency, but that benefit doesn't come to the DPD.
Okay.
That's why we say that.
Okay, got it. Thank you.
Thank you. We have the next question from the line of Prakhar Agarwal from Elara Capital. Please go ahead.
Yeah, hi sir. Thanks for this. Just two questions. One is, you at the start of the call mentioned that the credit cost guidance will be 2% with a variance of 20 basis points. What makes you add this 20 basis points? Because last quarter last time when we had this call, we said the credit cost will be around 2%. And with the type of confidence that we are showing in our improvement on asset quality, what makes you increase the guidance on this or on variance on this credit cost?
No, I'm not confirming that, right? We would want to keep that something in our hand for future which is unknown. Right? Our endeavor is to keep it within 2%.
No, so the thought process of asking this is we did not highlight this in the last quarter. So has there something changed in one quarter for us to add this variation? Or
no, nothing that one should read here.
Always we are talking about that 2% credit cost, 20 basis point up and down.
Got it. And second is on the update, any update on the core banking transition that you probably asked that were to happen for other portfolio apart from housing? What is, when is going to happen and what is the sort of impact that probably see, given what we are aspirationally targeting in terms of growth of 20% and the run rate that is required? Could there be some sort of impact on that front because of this core banking transition if that happens?
So I request Ratan to take that question.
Hi, Prakhar, like we made last time, couple of weeks back, we said that we would definitely make an endeavor to make sure that in Q2 we do the migration. Given that it's a mega migration, we are actually deciding whether to go big bulk in one go or we would like to sort of go in maybe two phases. That decision that we will take internally depending on how things go. So Q2 definitely we will go live for a big chunk of it for sure. Will there be some disruption for a period of 2 to 3 weeks in such a migration? There could be, but the upside is significantly higher and therefore you may see some disturbance for maybe a couple of weeks or little more than that, but it will come back with even more benefit in the next few weeks.
Sure, that is it from my side. Thanks a lot.
Thank you.
Thank you. The next question is from the line of M.B. Mahesh from Kotak Securities. Please go ahead.
Hey, Sunil, just one clarification. This 920 crores of slippages from the EEB book, that has no one-off, right?
No, that has no one-off. It's not
that slippage is also right.
Sorry?
Even if you just look at that slippages, just the 920 crores coming from your core business, that itself points to still a very high slippage number on the MFI book.
No, I agree with your point that it's slightly higher than our liking, but that typically happens in Q1, which is for lack of better words, I would say a sluggish quarter for us. But incrementally, if you break it between April, May, and June, the June month has been around little less than 200 crores or around 200 crores. Okay.
If I just kind of look back, 1Q FY23, there the slippages have been much lower in the MFI book, but this year has been worse off than even last year.
No, Q1 is not comparable last year. Our book was under moratorium. Half of the book came out on 1st April and the other half came out in 1st July. So any which way, April, and none of them would slip into NPA in Q1.
Okay. Just another clarification. This notification had come off in April 1st.
Yes.
You couldn't flag this in the previous quarter, right? In the quarterly results. Any reason why this was not kind of told at that time?
No, but that doesn't change, Mahesh. These were anyway part of the stress pool and they continue to be the part of stress pool. Right? We don't need to take any provision, but we continue to take provisions the way we used to have it. So nothing changes as far as the risk on the bank goes.
No, the service do say that it's a material item for the quarter. But given that this notification had come on April 1st, wouldn't it have been better if this was told in the previous quarterly results?
No, Mahesh, see, I appreciate that. Whether we say it in the first quarter, then the question comes, if you believe it is important, then why didn't you factor it in Q4 results? Which I would not have been able to factor it in Q4 results because my auditors would not allow it. It is applicable from this financial year. So if I say that this is something which you need to factor in Q4 itself, then the other side, which is the auditors, will push me to, will tell me that I won't allow you to factor it.
Okay. Perfect, sir. Just one question to Mr. Ghosh. These expenses continues to run quite sharply for a business which has completely slowed down. How should we see into this?
No, if you see that the cost to income ratio, in that sense, if you see that my cost to on assets remain that 3.5%. It is not change anything on that. Only that point because of the seasonality and my income has come down. And second thing is that I have been opened 130 branches in this quarter, and there is also little bit cost has given. It is not the cost; it is an investment of the bank. So we are, which is projected on that. We will like to get back on that cost to income ratio.
Okay. Thanks, Lord.
Thanks.
Thank you. The next question is from the line of Darpin Shah from Haitong Securities. Please go ahead.
Yeah, thanks for the opportunity. Just to continue on this migration or system upgradation part, when we are saying that most of the bulk will be done in 2Q, after that we are expecting a 20% growth in the overall book. Is that right?
Yes, we'll go it.
Okay. But just to again check, in the 2Q Concall, you had mentioned growth of around 22 to 25%. So why there is a dip of almost, say, 300 basis points or 500 basis points in the growth guidance?
No, we are strict on that at the 20%. Always we are talked about the 20%. Okay. Fair enough. Yeah. Okay. Thank you.
Thank you.
Thank you. The next question is from the line of Param Subramaniam from Nomura. Please go ahead.
Yeah, hi. Thanks for taking my question. I just wanted some clarity around this ECLGS exposure. So this 580 crore, this is the gross exposure to all those borrowers, right? Not the just the 20% part that is guaranteed by the government, right, Sunil?
No. So two things here. Firstly, this is the entire exposure. 580 crores was at the beginning of the quarter. During the quarter, we recovered 85 crores. That's one. Two, ECLGS, there is nothing 25, 75. 100% of the loan is guaranteed.
Okay, so this entire 580 crore is guaranteed. And that is the gross exposure to all the borrowers to whom this 580 crore has been given out. Is that reading is correct, right?
Yes. And outstanding today is a little less than 500.
Okay, got that. Just a bit of clarity around this again. So you're saying here that you have a coverage of 86% on this, and you had this previously also. So I just wanted to understand how you're attributing the PCR drop quarter on quarter to this ECLGS part. If you could just run us through that that quarter on quarter PCR drop, how it's coming through because of the ECLGS. Yeah.
No. So what we are saying is between CGFMU and ECLGS together, we have a coverage of 86%. Since it's a 100% guaranteed loan, ideally the regulator says that you don't need to make provision. But between the guaranteed portion of CGFMU and ECLGS together, we have 86%. Now let me tell you one more point. If you look at my Q4 FY23 presentation, we have mentioned there that 99% of my NPAs are government guarantees. If I may loosely, though it is strictly called the CGTSME or the NCDTC guarantee, are covered under these guarantees. So that was the case in March 23, and it continues to be the case even in Q1.
Okay, got it. Yeah, just one more question. This is on the DPD movement. So the slide on Assam portfolio's DPDs. The quarter on quarter doesn't seem to show any uptake across DPDs for Assam. Despite. So is there any impact that we could expect coming into Q2, or is this largely recognized? Yeah, that's it from me. Thanks.
So the Assam flood impact is not material. Even if it comes in Q2, we don't see it to be materially impacting our numbers because our collection efficiency there continues to be healthy.
Okay, fair enough. All the best. Thank you so much. Yeah.
Thank you. Thank you. We have the next question from the line of Abhishek Murarka from HSBC. Please go ahead.
Yeah, good evening, and thanks for taking my question. The first question is around NIM and cost of deposits, right? So you said in your opening comment that loan growth would be around 20, deposit growth would be higher. So LDRs would continue to go down. CASA ratios probably would end the year lower than 39.5 or your period end number for FY23. And so incrementally, how do you see sustaining at this level? You gave a guidance of, I think 7% plus or something. So don't you think there should be NIM pressure going forward?
Clearly, we've given a range of 7 to 7.5, and we absolutely not see any reason why should we change that range. Right? Despite our CASA ratio dropping, and more importantly, the cash share dropping within CASA, we've still been able to maintain it. Which we believe we will be able to reverse it. I'm talking about the CASA ratio. And if that happens, there is no reason to believe that we will not be in our guided range.
And Sunil, just to touch upon cost of funds or cost of deposits particularly, even if you start accreting more CASA, incrementally the rate differential between a TD and SA, SA rate is still pretty high. So your incremental funding will still come from TD. Plus there's a back book repricing. So your cost of deposits, which have gone up, I think 50, 60 basis points QOQ, what kind of trajectory do you see that taking from here, let's say, over the next 2-3 quarters?
So this cost of deposits which has gone up is for two reasons. One is, you're right, the TD repricing will happen, and that impact, if I have to take March 23 as a base, is about 68 basis points, if everything has to reprice at today's rate. Right? The large part of the impact in Q1 is because of the mix change, which we are confident that we will be able to bring back that mix.
So you're saying additionally around 60-70 basis points of repricing is yet to be done, or some part of would have happened?
No, not on today's cost. I'm saying on March 23 base.
On today's cost, how much is left to be done? I guess that's the more important number.
So I don't have that number handy. I will have to recalculate that. We had done that on the March 23 base.
Right.
So we will do that and we can share with you offline. What is also important is the yield on advances, which we have seen going up and will continue to go up, as our assets on the advances get repriced.
Sure. Okay, thanks. And secondly, on your branch addition, last couple of quarters, we've added quite a bit of branches. Also, we are hiring, to probably man those branches. So what's the plan for the rest of the year?
So in all, we are looking at a 1,600 branch count by the end of this financial year. I would request Shantanu Singh Gupta to share, take this question.
Yeah, okay. So, first of all, thank you for the question. So we are getting closer to about, 1,700 odd branches as we move forward. And, to your question in terms of how we are evaluating this, we are seeing good traction in each of these branches as we come up. So, that is the plan, and we do believe that some of these incremental branches which will come outside of Bengal will add value to our overall deposit book. So that's the plan that we have in the new branches.
And Shantanu, if I look at your, let's say employee per branch ratio, it was north of 50. Now we've added a lot of branches, so that's gone to maybe 45, 46. So you'll probably get back to that 50 range or 50 plus range, or do you see more structural, lower employee per branch kind of ratio?
Yeah, so basically if you look at the model, it works, the recruitment happens upfront. So as we sort of move forward, we'll start, seeing the results coming out of additional resources that we're taking in. So I think, to your point, as we move forward, we need to have people on board to actually start generating business from these branches. So that's the background.
So we have to recruit at least 2-3 months ahead of opening of a branch. So that's why that headcount cost and the number has already been factored.
Absolutely. Yeah.
Understood. Got it. Thanks so much for answering my questions. Thank you and all the best.
Thank you.
Thank you. To ask a question, ladies and gentlemen, we request you to please press star and 1. The next question is from the line of Nitin Agarwal from Motilal Oswal. Please go ahead.
Yeah, hi, thanks. Just a small question on collection efficiency again. While Sunil, you mentioned that the drop is slightly due to seasonal factors and monsoon also, but Assam and West Bengal both have still improved. Now that the other states are forming the majority of the book, so any specific states which have contributed to this decline?
If you see that the disease in Maharashtra and Madhya Pradesh and Delhi.
Okay. And sir, will these be the 3 states in terms of the proportion of EV book also in that ranking?
No, so for us, after West Bengal, it's Bihar, followed by UP, then Assam, and then MP and Maharashtra.
Right. Sure. Thanks so much, Sunil. Thank you so much.
Thank you.
Thank you. We have the next question from the line of Prabal from Ambit Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. Sir, what is the outstanding restructured book?
Sorry to interrupt, Prabal, but the line for you is not very clear. We request you to please use the handset while you're speaking.
So what is the outstanding restructured book for us?
0.
Sorry?
Zero. When I say zero means none of my customers are currently under any restructuring benefits, whether it's moratorium or any change. That has come out long back since September 21.
Okay. The second question is sir, on ECLGS loans. Were these already into 90 plus DPD, and because of the RBI circular, they were classifying it into 60 to 90 DPD?
So it's a government guaranteed loan. So as per the IRAC norms, then the government guaranteed loan cannot be classified as NPA. But since they were DPD loans, so we thought that if we can't classify them as NPA, at least call them as stress pool, and we showed them as SMA2. And they were always part of our stress book for the last 2 years.
And sir, one clarification. So in the beginning, MD sir said that there was one account of 2,200 crore which was repaid. So can you talk about that?
No, it's a loan against term deposit account. So we had a large deposit from a government entity. So they had taken a loan against that term deposit for a short tenure of 7 days, and that got repaid in the first week of April.
I'm just curious, why was the 2,002 crore account classified as a retail into the retail book?
It was never classified into the retail book. These are time deposits, and anything above 2 crores, as per our definition at a customer level, is treated as bulk.
Okay, got it. Okay. Thank you. All the best.
Thank you.
Thank you. The next question is from the line of Manish Shukla from Axis Capital. Please go ahead.
Good evening, and thank you for the opportunity. A couple of questions to me. What will be your average cost of term deposits on the book today?
Just a sec. Just a minute. About 7.1%.
And the marginal TD rate that you are offering today would be in about what?
About 7.7%.
So,
that's
I mean,
the gap. The 60 basis point that I was talking about.
Yeah, so I'm assuming no further deposit rate increases from here on. That is the extent of repricing on the TD side that one can expect.
Yeah, in fact, the last action on the TD was a drop in the last time.
Sure. Second, going back to the ECLGS point, right? So ECLGS, my understanding is that government scheme said that if you lend 20% to an existing SME customer, that 20% was guaranteed. So let's say you had an exposure of 100, you give 20, the 20 becomes guaranteed and not the 120. So now when you've labeled those assets as NPA, is it that the 20 has become NPA or the entire 120 has been labeled as NPA?
No, in banks we don't have that option. It has NPAs are always at KIF levels.
Yeah, so that's the clarity. So you labeled the entire 120 as an NPA, but the guaranteed portion will only be 20 out of that 120.
So this is the total outstanding of those customers, guaranteed, non-guaranteed, all put together.
Okay, understood. Thank you very much. Those are my questions.
Thank you. We have the next question from the line of Puneet Balani from Macquarie. Please go ahead.
Yeah, hi. On the total MFI pool, the EV pool at 62 billion. So it looks like a bulk of the slippages are, from SMA 0 and other accounts. You were saying it's seasonal, but can you comment more on this? What is it exactly? Because the number appears quite big, right? The 9.2 billion on MFI book and overall increase in the forward from the forward pool.
No. So first thing, let's understand this concept of slippages. Right? We have a large pool which is part of NPA, and there is a reasonable amount of customers who continue to pay us, though they pay past. Right? There are instances where customers are 10 DPD, 20 DPD, but they are NPA since they've been marked as NPA. Right? So on one hand, there is slippages, and on the other hand, there is recovery from slippages. Right. So that's one piece. If you purely talk about slippages, as I mentioned earlier, that my slippages typically in Q1 after a strong Q4 and typically seasonality, Q1 is weak, is slightly higher, and that has been the case always. If you compare it with the last year's first quarter, there itself we had a slippages of about 950 odd crores, right, of the total slippages of 1150 crores at a bank level. So this is not something unusual. That's the seasonality which always play out.
Okay. That's from my side.
Thank you. We have the next question from the line of Mahrukh Adajania from Nuvama. Please go ahead.
Yeah, thank you, sir. I just had a clarification. So basically, before April 2023, it was your call where to classify these loans, and as a prudent measure, you classified them as SMA2. So it's fair to assume that probably in December 2022 also these were part of SMA2 only, correct?
Yes.
Okay. Thanks. Thank you.
Thank you.
Thank you. Ladies and gentlemen, that was our last question for today. I would now like to hand the conference over to the management for closing comments. Over to you, sir.
Thank you, ladies and gentlemen. Thank you for the patient hearing and participation. Appreciate it. Thank you.
Thank you.
Thank you. On behalf of Bandhan Bank, that concludes this conference. Thank you for joining us. You may now disconnect your line.